welcome to Friends That Invest, the podcast that feels like a voice note from your favorite finance friend. I'm your host, Sim Kaur, and I am wildly passionate about education. And every Tuesday, I'll be breaking down investing in personal finance so you can stay confident and informed. Today's episode was a question that I was asked in the kitchen. I was not broken into. I was on a holiday, and one of our couple friends asked me, they were like, should we invest or pay down our debt? And I was a little surprised by them asking me because they are my fiance's boss. So I was like, I feel like you're probably going to know more about this than me. They work in finance, but nonetheless, it made me think about it. And I wanted to write this episode out because so many people have the same question. So in chapter 1, we're going to cover how much of your income is going to go towards the mortgage. In chapter 2, we're going to cover what happens if you pay down your mortgage. Chapter 3 will cover what happens if you invest instead of putting money into a mortgage. And chapter 4 is going to be what the experts recommend in the end. Also, if you are watching this video, my hair is up because it is so hot right now. Like, I am just a bag of sweat. And if you have never seen a woman with a sweaty mustache, you are going to be in for a treat by the end of this episode. But starting off with chapter 1, I wanted to figure out exactly how much people are putting aside from their income towards their mortgage. Like, is it something that takes up a lot of people's income? Is it something small? And I found that the average US mortgage debt balance per borrower is actually quite low. It's only $258,000 US. Now, this is the average, so it means it counts for people that have maybe bought their home in like a really cheap place, or it includes people that have like put a down payment down and have paid off their house quite significantly, and maybe they've only got a couple of years left on their mortgage. It's definitely not the average that I come across in my like small anecdotal evidence, but it was really interesting to see how low it is. But that also doesn't really show the full picture. And so to get a better idea, we had a look and saw that mortgage payments have actually climbed, unsurprisingly, thanks to higher income prices, elevated interest rates, and the national average payment has increased more than 20% since 2022. So that sounds a little bit more like what most of us are experiencing. Now, that was the US. When we look at New Zealand and Australia, we see that the average mortgage taken out in New Zealand was $590,000 and $690,000 in Australia. Now, when I saw this, I thought, well, that's not how much the average house price is. And then I had to remember, no, this is not the house purchase. This is the amount of mortgage taken out. So let's say someone buys a $800,000 house in Australia. The mortgage is their house price minus their deposit. That's how much money they owe the bank. So $690,000 suddenly starts to make a lot more sense. Again, this didn't really give me the data that I was looking for. It didn't tell me, are people putting everything in their income towards their mortgage? Are they enjoying life and having enough? What does the average mortgage look like? And how much are we putting away? And therefore, is it worth investing or not? So I wanted to know how much people's salaries were going towards their mortgage. And again, the data was quite skewed thanks to our, I was going to say our boomer friends, but that's not a nice way of saying it. Thanks to our mature friends that bought houses for $30,000. So I ended up doing some Excel, freaking the sheets, data analysis, and basically I took the average income from each country and I compared it to the current mortgages taken out in 2025 and then went to see, well, if a couple, both making the average income, took out an average mortgage at the current rate of like 6.5% on a 30-year term, how much are they putting from their income to their mortgage? In New Zealand, if a couple had $140,000 household income, so about $70,000 each per person, which is about the average salary, and they had the average mortgage of $590,000, then they would be spending 31% of their pre-tax income on mortgage repayments. So for every dollar that they made, 31% of it would go towards their mortgage. And if we compared this on post-tax income, this number was looking more like 39 to 40% of their post-tax income going towards their mortgage repayment. So that's pretty high. But usually when we talk about what is a good mortgage repayment, anything under 30 is considered like the safe zone. So then we went over and looked at what happens in Australia, and we found that Australians were not struggling as much. First of all, the average household income in Australia is $200,000. And the average mortgage was $690K. So they had a lot more breathing room, where the average mortgage was taking up 26% of someone's pre-tax income. That's only a quarter. It's not a third. So it's starting to show that, yes, mortgages are quite high and they do take up a big chunk. And so maybe it's worth paying it off early. Maybe it isn't. It's hard to know what the right answer is. So I did the data. I did the research. And so now let's talk about chapter 2, where we learn what happens if you do decide to pay down your mortgage faster. So let's say you go to the bank, you're like, okay, Sim, I have got my mortgage. Fantastic. I need to pay this down, and I actually don't know what my mortgage is even made up of. Your mortgage is broken up into 2 separate parts, the principal mortgage and the interest. The principal is the actual cash money that you owe. So if you take out a $690,000 mortgage, the principal that you owe is $690,000. But for the sake of simpler math, let's just call it $500,000. You take out a mortgage and it's only $500,000. And so you owe $500,000 to the bank in principal money. You're like, hey bank, I need this money to buy the house. I will borrow this off you. The misconception that a lot of people have, myself included when I started, is you don't just owe the bank $500,000, you owe them that plus interest. So the first part of your loan is the principal, $500K. The second part is the interest. And this is the amount of money added on top of the principal. It is variable. So some people might have a 3% interest rate or a 6% interest rate or a 7% interest rate. And this is paid on top of the principal, even though your mortgage repayments are taken out as one amount. So every month when you pay your mortgage, let's say it's $2,000, that is made up of principal money and interest money. You don't have 2 separate payments. And one of the most depressing things I have ever realized in my life, outside of just knowing that every war was started by a man, the first part of your mortgage for the first couple of years, maybe even up to the first 10 years, most of your money is just going towards paying off the interest part of your mortgage. And so if you had a $2,000 a month mortgage payment, maybe $1,500 of that would be just paying off the interest, and only $500 of that would be going to pay off the principal. The math isn't completely accurate, but it's just trying to showcase that most of your money is just going towards the interest. Not a lot of it is actually chipping away at the interest, the actual main heart of your mortgage. I feel like I'm throwing a lot of numbers out, so maybe the best way to explain this is to use a real life couple example. So let's use a couple called Jazz and Bobby, and they have a $500,000 mortgage. They've just bought a home. They have a 5% interest rate, and they have received a $100,000 windfall. They've had an inheritance come in. It's a lot of money, and it's huge. And so they're trying to decide, do we pay off our mortgage, or at least pay down some of the mortgage with this $100,000 windfall? Or should we take that money and invest it? What is going to give us the best returns? What's going to make sure we're setting ourselves up for success? And how do we make good, smart money decisions when these aren't the things that we got taught at school? So when we're weighing up the idea of, okay, what if we, pay down that mortgage? We've got $500,000. We take $100,000 off it. That sounds pretty good. And there are some benefits to paying off your mortgage. The first is kind of what we spoke about. It's to reduce your interest costs. So should they pay down their mortgage, there are a few benefits. The first is to reduce interest costs. If their mortgage interest rate is 5% and they put $100K down, you're going to stay with me for a second here, but that is the equivalent of getting a guaranteed risk-free return of earning 5% after tax. If their interest rate is 5%, they put $100K down on their mortgage, that is equivalent of earning 5% after tax, guaranteed risk-free. Reducing their mortgage also gives them more peace of mind. It can increase your monthly cash flow because your mortgage repayment rates will drop because your mortgage is now only $400,000. It also can help you build equity faster because now instead of maybe having $100,000 or $200,000 in equity, you have $300,000, and you can use that money to borrow with the bank to buy another home, to buy an investment property. Maybe you want to start a business. Banks love, love, love lending money from your home equity because they see that as a very safe loan as opposed to just giving you cash, not having anything to back it. The other benefit of paying down your mortgage a lot faster is it protects you from future interest rate hikes. If you are an American, this doesn't really apply to you. Our American besties have fixed mortgage rates for like 30 years, which is not the norm in like Canada or Australia or New Zealand. Our mortgage rates often change every 5 years or every couple of years. And so if you are on a low interest rate, maybe it makes sense to pay it down faster. And so for our couple with Jazz and Bobby, they're like, okay, well, Sim, it kind of sounds like a good idea. If I have this 100K and now I only have a $400,000 mortgage, what would that look like in terms of the math, in terms of the numbers? The first thing is that they'd have a monthly cash flow free up of $537 a month, or about $6,400 a year. But if they kept their repayments the same, they didn't reduce their repayments and keep that extra $6,000 a year, they would actually be able to pay off their house so much faster. They'd be able to pay it off in 21 years. And like, that is a huge money win. It means lower stress if one of them loses their job. It means more equity, 100K more equity if they want to buy another house or start a business or fund renovations. And so there are some really good reasons why someone would want to pay down their mortgage. But now Jazz and Bobby say, well, Sim, that sounds like a great idea, but we want to be smart with our money. What would it look like if we took that $100,000 and didn't use it to pay down our mortgage? We used it to invest instead. Like, is that better? Are we going to make more money in that way? Like, how do you even compare it? So with Jazz and Bobby, if they went down the mortgage paying down route, by putting $100,000 down, they would save about $200,000, give or take, on interest over 21 years. And so they're not just saving $100K on their mortgage, they are saving over $200,000 worth of interest payments. And saving almost $200,000 worth of interest payments is like gaining $200,000. So in almost like simple math terms, pay down the mortgage, they have $200K. So we'll put that aside and we'll compare it to what happens if they decide to invest that money. So let's say in the same situation, they have $500,000 mortgage, they have a 5% interest rate, they receive this $100,000 windfall, but instead they decide to invest that money. What would that money look like after the same time frame, 21 years? Would it be more or less than the $200,000 they save on the interest by paying down their mortgage faster? Now, in this scenario, we're going to assume they put the $100,000 as a lump sum, they don't invest any more money, and they just keep their mortgage repayments the same. There's a few pros to investing instead of putting money down on your mortgage. I'm going to try and be as unbiased as possible because obviously I'm a fan of investing, but the pros of investing include hedging against inflation. It includes, and the second one is probably my most favorite, just having liquid access to your cash. $100,000 into a mortgage is not money you can go and like swipe and use and spend. But maybe you live a life where you've got big expenses coming up or something's going to change. Maybe you're moving overseas and you want to keep things a little bit more liquid. Then having your money invested in the share market means that you can, if you need to, draw it down a lot faster. Getting money outside of a home and remortgaging it or selling the home obviously is going to cost you so much more money. So if we looked at the $100,000 and assumed that they invested in a broad market index fund and based on historical returns, not to say that past performance can even guarantee future success, but let's just say they get 7% annually. After the first year, their money goes from $100,000 to $107,000. And you might be thinking, Sim, that's like, what am I going to do with $7,000? That's a lot of money. That's nice, but I'm not really feeling convinced. Yes, year one, you're not going to see a lot of change. But by year 21, the same time frame as if they were just going to pay the mortgage down, they would have an investment portfolio of $414,000. And $300,000 of that is coming from the interest. $100,000 is coming from the principal, the 100K that they put down, and then $300,000 more has come from investing. And so if Bobby and Jess were like, okay, so let's compare between the two options. If they invest their lump sum, $100,000 to pay down their mortgage, then they save themselves $200,000 in interest rate fees. That is incredible. If they invested the same amount of money over the same time frame, they could make $300,000. And so from a complete financial scenario, investing does give you higher returns than paying down your mortgage, which kind of makes sense because in their situation, if they had $1, their dollar works harder by gaining 7% in the share market than how hard their dollar would work by paying down 5% by paying down their mortgage. 7% is more than 5%. And so as a result, it only makes sense that their shares would grow more than their mortgage. As you might notice then, you might be thinking, well, Sim, in their case, their mortgage was 5%, but my mortgage is going to be a different percentage. So how do I know if that's right for me? And so when it comes to choosing if you should pay down your mortgage or not and instead invest, there's kind of 3 questions I like to ask. First question, is my interest rate close to 6%? Yes or no? Number 2, do we have unsteady incomes? Yes or no? Or 3, do we have a low risk tolerance? Yes or no? If you've answered yes to 2 of these questions, even if financially it might make sense to invest, maybe emotionally and maybe what's better for your family is to actually pay down your mortgage. Because a higher interest rate, anything close to 7, like 6%, it suddenly doesn't feel as justifiable to invest that money because you can invest that money in the share market for a riskier chance of a 7% return. But if you have a 6% mortgage, paying that down is a guaranteed 6% put down on the debt. And you can't get that wrong. That is guaranteed. If you have a 3% or a 2% mortgage, it's a lot further away from 6%. So that's great. In that case, yeah, absolutely. Invest instead of paying down your mortgage because the amount of money that you can pay down is only 2%, only 3% versus gaining 7%. Having an unsteady income is also an important consideration. If you are a doctor and a teacher, then you probably know that you'll have jobs for the next 5, 10, 20 years. I mean, I don't know what AI is planning to do, but you're probably less likely to need to pay down your mortgage faster versus if maybe Bobby and Jazz were like, hey, we're actually both entrepreneurs and right now our businesses are doing well, but we don't know if it will in the future. And we don't know if we'll have cash flow in the future. So let's pay down our mortgage as fast as we can. And also a risk tolerance is a huge thing that is not something we need to skirt over or be like, oh no, it should be fine. Like in my parents' case, they wanted to pay down their mortgage as fast as possible. Their risk tolerance was very, very low and it worked out for them and they feel like they can, relax. Where in my case, when I look at those 3 questions, is my interest rate close to 6? No, I have a lower interest rate, so that's fine. Do I have an unsteady income between me and my partner? Mine maybe, but theirs is steady. And so together, that's fine. And then do I have a low risk tolerance? Absolutely not. I have a high risk tolerance. And so by looking at that entire framework, I can say confidently that no, I will invest more rather than paying down my mortgage. But there was a time when my interest rate was like 6.5%. And so instead of investing, I actually put a bit more money down on my mortgage to pay it off a little bit faster. So the answer to if you should invest or pay down your mortgage is really a variable based on your interest rate, the steadiness of your income, and your risk tolerance. And I wanted to go and see in chapter 4, what are professionals saying? What is it that is being advised to the everyday person? And there was really no consensus. It was like the Android versus Apple debate of the world. The quotes could not be more contradicting. There was one quote by a professional that was like, the textbook view is that you should pay off your mortgage as quickly as you can because the risk-free return equals your interest saved. Perfect. And someone else was like, paying off your mortgage is stupid. And so I really sympathize with people going, what should I do? Because there is absolutely no right or wrong answer. And at the end of the day, if you do one or the other, you are still getting ahead. Like if Bobby and Jazz decide to pay down their mortgage, that's still a really good option. Congratulations. Like you have less debt. Fantastic. Your net worth is increased. And if they go, we want to invest that money in a broad market index fund, that's also incredible. You know, they're creating wealth that way. There's no right or wrong way. The only wrong way is getting so paralyzed that you make nothing in the end. And I remember this one investor saying something to me that really changed my perspective. She said, rather than this or that, why not this and that? Maybe Bobby and Jazz should like put $50K down on their mortgage and also invest the other $50,000 and have best of both worlds. And that I was like, wow, that is so simple, but like so true. And so at the end of the day, there's no wrong way to look at putting money away in your mortgage or to invest. It really comes down to your personal finances. That's why we call it personal finance. But again, if you ask yourself 3 questions, do I have a high interest rate? Do we have unsteady incomes? And do I have a low risk tolerance? That is going to get you to a much closer answer of what you should do. And the only wrong thing to do is to do nothing at all. So with that, I hope you enjoy this episode and I will see you next week.